Hi, Jerald.
Hello.
How are you?
I'm
Hey,
good. How are you?
here. I didn't know
Yeah.
you were your hair
Oh yeah, I just haven't cut it.
today. This is the pandemic hair.
Yeah.
How's it going? Happy Sunday.
Happy Sunday to you as well. Appreciate you having me.
Of course, of course. I'm just letting folks join in now. How's it going with you? Pandemic.
Surviving, election on Tuesday, so very busy week from a research perspective, but enjoying my time off for today.
Okay, that's a
How have
good
you
one.
been?
Uh, good. Loads happening, but I'm already prepared that Tuesday is gonna be, a roller coaster of a day. And I don't even think we're gonna get the results on Tuesday. What do you think?
Yeah, I think you're right.
Yeah.
Oh.
Yeah. We're just gonna give folks a few minutes to join in.
Sure.
Thanks to all who've joined so far. We can kind of start at like 10:05, so 5:05 Lagos time.
Sounds good.
Awesome. I hope you're staying safe in New York.
Yes. I traversed down to Queens yesterday to visit a Howard alum actually, but other than that, I pretty much just stay in Harlem all the time. So.
Oh, at least you went out.
Yeah. I mean, how's it going in Dallas?
The numbers are not flat, so I'm
Okay.
home. I'm home.
And do you still live in the suburbs out there?
No, I actually moved. I moved downtown.
Oh, where you live downtown?
Actually, right by Uptown.
Okay.
Right by West Village.
Yes. Okay.
Mm-hmm.
Nice. When'd you move?
When? Oh,
Yeah.
maybe 2 years. Right after you left.
Oh, because I remember you had a whole house.
Yeah. So right after you left, it's better, but like I haven't even gone into the office this year. So, well, since March.
Yeah.
So.
Have they tried to bring people back in at all, or not really?
Folks are going back in. Yeah, folks are going back in, but I'm like,
Hey guys.
hello, welcome
No.
everyone. Oh my God, is that Fata KG?
It is. I'm actually about to get in the train, but I said I must join this one today.
Oh, thanks
I'm
for
just enjoying you guys' conversation.
How you doing?
I'm
I'm good. There's another lockdown in London happening on Thursday, so
Yeah, I heard.
yeah, it's mad still. But it's cool. It's cool. I'm getting in the train now, so I'm gonna go on mute.
Okay.
All right. We're gonna get started in another minute here. Okay. All right. I guess I can go ahead and start giving some introductory messages about my very good friend Jerald, and we can get started. Folks can join us as they trickle in. I see a bunch of people still kind of in the waiting room, so. But yeah, welcome everyone to our second session of the Trove webinar series. I'm super stoked to be co-moderating and hosting today's session with my good friend Jerald. Um, Again, if you don't know me, my name is Desaya Joshagiri. I'm a co-founder at Trove Finance. And we kind of put this together to make sure that folks are, in the weeds, talking to the right professionals, getting the right information, around what's happening in the stock market. Like I mentioned, we had one yesterday. This is the second session, and we have two more upcoming in the next week. So if you want information on that, feel free to use the chat box. As we actually did yesterday, everyone is going to be on mute just to make sure that the session goes well. All the questions should be funneled through the chat box. I would read the questions around, say, about 45 to 50 minutes in, depending on how quickly Jerald is able to get through his content. Let's all continue to maintain decorum. If you have any questions, you can feel free to chat me privately. But without further ado, I would turn the floor to Jerald. Jerald is a seasoned professional on Wall Street, my personal friend. If you joined early enough, you'd have noticed that we're exchanging some pleasantries. He's super learned and also attended Howard University, HU. Got to put that plug in there. And yeah, today he'll be talking to us about investing for the long term post-COVID. Jerald, over to you. Thank you for joining.
Thank you so much. So wonderful to be here. Wonderful to hopefully meet some of you during the Q&A or get to know you. I am an investor professional. I don't know if I'd call myself seasoned. I think the sounds being flattering, but I've had 3 kind of different jobs within the landscape of investing. So my first job, which is when I worked with Desio, I was at Goldman in what's called the Special Situations Group, which is Goldman's, it's not part of the merchant bank for those of you who are familiar with Goldman as a company. And so it is a group that invests kind of Goldman's own funds in a variety of investment strategies. And I was specifically focused on what's called private credit with some kind of distressed debt. So it was more fixed income based, but we did have some equity investments. And so I just wanted to set that table because, my framework for long-term investment is kind of built off of the idea of being a distressed investor or at least a high yield investor. Some of the questions you have that you ask yourself for that. And so from there, after 2 years from there, I worked at a hedge fund called Point72. That's for those who are familiar, that's Steve Cohen's hedge fund, and was there for about a year covering financials and fintech. And so there, just long, short equity, just pitching stocks long and short, nothing really scientific about that. But my boss also came from the special situations group, although he was about 10 years my senior. And so once again, I had that kind of that framework of investing kind of instilled in me. And so now I'm in a seat at AllianceBernstein, working within a fund called Responsible U.S. Equity. So it is an ESG fund. Also want to shout out my boss, my portfolio manager, Valerie Grant. She is a Black woman. She's awesome. And she's been teaching me a lot. And so I just want to say, that's kind of the background on how I think about investing. So, I think about the long term, but because of my credit background, I'm very big on risks. And so, since the theme of this is, investing long term in this pandemic world, I want to just kind of start with, 2 things that I think have changed most in terms of how I think about investing. Is that I feel like the pandemic has put a lot of volatility in terms of just the macroeconomic picture. So whether that's, high unemployment, lower spending, it could be, like local municipalities are struggling. That can mean a lot of things. But for the purposes of investing, I think the biggest thing is kind of lower employment, and also that leads into spending. And the other arguably bigger issue here is related to the change in consumer behavior. So because of the lockdowns, there really is people aren't going out now. I know some of you may be on Instagram. Some people are going out, but for the most part, there is the same volume. So if you just think about airlines, for example, right? People are flying at basically 30% of what they did last year. So there's just been this mass change in consumer behavior, whether it's because of, they're working from home, or if it's because of, they're concerned for their safety or their family safety, or it could be because of actual lockdowns, where we talked to Diane, where if you're in London or Germany or France, you literally can't leave. So that's changed consumer behavior. So, on what point you might have thought that, I don't know, Planet Fitness was a great investment, right? But not anymore, because people aren't really going to the gym. People are getting their Pelotons. They have money. People like me are doing their, HIIT workouts on YouTube for free. So people are making it work. So I think one of the questions you have to ask is, how is this being interrupted currently, and how could this change? Because another thing you have to ask is, what if there is a vaccine in the next year or two, So just because you think people are, going to continue to use e-commerce now, that could change quickly. If there's an announcement for a vaccine. Even if the vaccine isn't rolled out 2023, stock markets react to news, not when the point of time something happens. So if there's a vaccine announced, a lot of these trades that are happening. So if you think about, Netflix, I'm trying to think what are some others, PayPal, some of these more kind of e-commerce, be it home stocks. I also throw in like Best Buy, people are, upgrading their home tech because working from home or just for a new entertainment, if you're like a gamer or something like that. So always ask yourself, how will this be influenced by changing behavior as the pandemic waxes and wanes? I mean, we saw here in America, at least, we saw, it seemed to be like a light period in August and July where there was probably lowering of cases. Now they ramped back up. So that has to keep in mind. So I say that to say, when I'm looking at an investment, I want to make sure that the risk factors or the variables that will determine a company's success are independent of consumer behavior and are independent of the overall economic strength of the globe. So obviously, if during a recession, all companies somewhat, they don't do as well, but there are certain industries that do better. And so now I'm kind of going to go through some of the things I look for in a long-term investment. And so I think this will really help in terms of the pandemic. So some of the things I like to look for in a company are, are they asset light? And so asset light just means, do they need a lot of heavy machinery to generate income? And so, granted, there's nothing wrong with a heavy industrial type of company or an oil and gas company. But given that, there are some factories that shut down, as well as, these factories, they require a lot of investment or capital expenditure to maintain, there's going to need to be, that's something that I don't necessarily prefer. Although I will give you an example of when that may not be the case. Another thing I like are service-oriented companies. So a service-oriented company just means that they don't have to produce a widget, or it could be food, it could be a TV, whatever. They don't have to produce something to make money. They have some kind of service they provide. It could be consulting, it could be financial advisory if you work at a place like Goldman, and it could also be something as simple as pest control. So, that is a service because you don't need to buy, one can of X to service multiple customers. You can use, your equipment across months. So that's why I like companies where their revenue, like if you have an upfront cost that can generate, quarters or months or weeks of revenue. Those are kind of companies I like. Similar to that, I also prefer companies that are more recurring in nature. And so, they're not a one-off item. So an example of a one-off purchase would be like, if you have a car company. So that's a durable purchase. So if you, are investing in a car company, you need to be aware of the fact that people probably are only buying new cars every 3, 5, 10 years, depending on the consumer. I like companies where their revenue, their customers have to pay them on a recurring basis, on a contractual basis. What does that mean? So one company I really like is Waste Management. It is the largest waste services company in America by about, I want to say 20%, 25% larger than their second largest. And so even though it's, I don't know, people think trash as a contractually obligated thing, but literally if you do not pay Waste Management, your trash bins will overflow. No matter if there's a recession, no matter if people are at home, don't nobody want overflowing trash. So that gives me comfort in the fact that, okay, no matter what happens in the pandemic, Waste Management is going to get paid. So that's what I'm thinking about when I say evaluating risks. Like, what are businesses that will continue to go on regardless of what happens with the pandemic? And the reason I like recurring revenue is because the trash people come every week, every month, depending on, what kind of property or business you're running. So that means every month you have to pay them. And it's contractual. So if you don't pay them, they don't provide the service. So to me, as an investor, that gives me confidence that their revenue and profit levels will remain steady no matter what the outcome is of this election or the pandemic in the coming years. So that's just one element. The next element I would say is there needs to be some kind of secular tailwind independent of economic growth. So once again, what does that mean? So, there are a lot of companies where they are levered or like their success is in part determined by, how well the economy is doing. So an example of this would be the housing starts, right? So generally speaking, if the economy is doing well, people are able to afford and buy homes. If the economy is doing well, less people can afford and buy homes. I prefer industries where they're not tied to things like the broader economy. So like I mentioned, waste management, right? People need trash taken out. because it is both, a visual eyesore, but it's also can be an environmental and safety hazard if there's certain toxic waste that needs to be disposed of a certain amount. So, because it's what's called mission critical to a business, that means like this has to be paid. Like this is keeping the lights on, quote unquote. I like those kinds of businesses. You have to pay them, and it's contractual revenue. There is a contract we have that states you have to pay me every month or every quarter, whatever the timeliness is of it, for a year, for 2 years. For waste management, some of those contracts are up to 7-8 years. That just gives you an idea of kind of how confident you can be in their revenue levels for the long term. And those are the kind of investments I like. And when I talk about secular tailwinds, so with waste management, right? They are the largest waste services business in America. They're also one of the largest recycling services businesses in the world. And so when I say secular tailwinds, no matter what you think about the economy, people are becoming more interested and more aware and more conscious of the environment, of our waste levels, and having recycling versus trash. So with waste management, even if there is a shift in people maybe try to be more environmentally friendly, use more recyclable materials, that still benefits waste management because they are, I think, 3 times bigger than the second largest recycling services business in America. So to me, that says, okay, as more and more, so I'll give you an example. How many of you have used Amazon way more than you ever have during this pandemic? Right? So how many of you, maybe not think about it this way, but how many of you have accumulated more cardboard boxes than you ever have? That's literally money to waste management. So those are things, I think that people don't think about. There are these secular trends where, as more and more people do e-commerce, even more and more people, eat food out. Some of those plastic containers are recyclable. So as we get more and more of kind of these new materials that can be recyclable, that's just more revenue that can only really be, that's going to be recognized more so by waste management than some of their competitors that are more focused on waste services versus recycling services. So it's kind of to reiterate kind of what the things I liked about this investment were, even though waste management isn't necessarily asset light, with one truck, you can service multiple customers. So even though there is heavy machinery involved, you can, it's not one product per one customer. It's service oriented. So essentially they are collecting as well. They're collecting garbage. They are then compressing it to make it smaller, then putting it in a landfill. That is all services. They're not providing any specific product to you. I like those businesses. Recurring revenue, right? You have to pay them every month to take away your trash. Like that is mandated. If you don't, your trash will overflow. Then the tailwind, they are very well positioned to take advantage of more and more people being conscious of recycling. I don't know if any of you are aware of this, but all the large consumer packaged goods companies like General Mills, Palmolive, Colgate Palmolive, and those like that, they're all committing to moving their products to 100% recyclable material in the next 10 years. So that's just, once again, more volume that's going to be put probably towards waste management versus their competitors. Another thing that makes, I think, investments attractive, and this is for all investments, is an attractive valuation. You don't want to pay too much, right? But the question is, how do I know I'm paying too much? Well, unfortunately, I can't answer that for you at this time. This is something that, you have to make a judgment on based on whether it's a discounted cash flow analysis. It could be like a LBO analysis, and it also could be, just a relative valuation, so a comps perspective. But you need to figure out, okay, so these other things I like about the company, are these strong enough to warrant the valuation I'm paying? Now, if this valuation looks cheap compared to peers, and all those other checkboxes are marked, then that's great. But a lot of times it's not that simple. The stock market is what we call very efficient, which means there are a lot of smart people working there to figure out and ask the questions that you may be asking. So it's important to make sure, if something does look cheap or too good to be true, quote unquote, maybe it is, maybe it isn't, but you better do your homework to make sure. So just want to break it up there. So next thing I like is high free cash flow margins. So it's one thing to have high margins, which is, income. So that's, revenue versus expenses that have been realized. But I like to look at free cash flow because at the end of the day, you need cash to pay for things. You can't pay for things with IOUs, right? And you also, you need to, so an example I have for this. So if you just look at income margins or, earnings margins, net income margins, Netflix is positive. But what Netflix doesn't show on their income statement is that they capitalize, or so capitalize means they incur an expense, but they recognize it over time. So they capitalize their content spend. So when you see Netflix, gets rights to a big movie or a big TV show, they have to pay for that. But they're paying for that in their cash flow statement, which means that what people don't know about Netflix is Netflix has never turned a cash flow profit in all of its years of operating. But it has turned an income profit. So its earnings are positive. So I always want to look at cash flows. I want high cash flow margins, because even if a company is more so geared towards growth, so you're buying it because you think their revenue will grow, those high margins will give you security in the event of economic pressure. So if you're a company that has 50% margins, something happens, now you're 30% margins, you can still pay your bills, you can still, pay off your debts, you can still potentially issue dividends or buy back stock. If your margins are 5% and they get compressed to 0%, you have no money. So I'm gonna make this clear though. If there are higher margins, there likely will be higher valuations. So you need to find that balance between, okay, I want higher margins that gives me a level of safety, a level of downside protection. But at the same time, make sure you're paying the right price for those margins, because at times high margins can be overpriced. And even though those investors don't kill you, you'll be disappointed, when your friend is investing in another stock that grows, but yours seems to be pretty flat because you paid too much for it. I think this is something that I've recently learned from my boss, Valerie Grant. Please look her up. She's wonderful. Is utilizing the Porter's 5 forces analysis. Now, this is something that I was made familiar with during my time at Howard. And if any of you have business school experience or taken a management course, that is a staple of the management courses is the Porter's 5 forces. And so what that is it analyzes a company's what they call 5 competitive forces. Really, it's 4 that leads to 1. So first is that of suppliers. So, do your suppliers have power over you? Do you have a diversity of suppliers? So if one raises their price and go to others, do suppliers force you in a long-term contract so it's hard to get out? So those are the questions you ask for a supplier, for the debt of suppliers. Debt of buyers, do your buyers have a lot of options to pay? Also, for buyers, are you offering something different than others? Are your products cheaper? Do you offer better services? Those are some of the things that you want to ask for a threat of buyers. Other one, threat of new entrants. So, are there barriers to entry for your industry, right? So one positive aspect of heavy industrials or asset intensive businesses that serves as a barrier to entry. It costs money to build huge machines, right? But if you're a consultant, let's say, anybody can join the field of consulting, because all you need is expertise. The fourth is the threat of substitutes. So a good example of this would be, I sell, maybe Shake Shack. They sell hamburgers. What if a new company comes around and they sell super great hot dogs? Now, they're not necessarily competitors, because Shake Shack competitors probably Five Guys, McDonald's. But at the same time, if I want something quick to eat, like something lunch, a hot dog is still a substitute for a hamburger. And so all of those factors come together to form how strong is the existing rivalry. So that is the fifth and most important. So who are your competitors? So I think the most present example of where, there's this huge competitor that you need to be worried about is Amazon. Basically, every company is competing with Amazon to some extent. So one of the questions I now ask myself in investments is, can Amazon do this in 2 years if they want to? So that's something I think about when you think about, existing rivalry and substitute. So I say all that to say, you want to make sure your company is in a good position from has an attractive competitive position. You don't want a company that has too many competitors that aren't differentiated. You don't want a company that has a commoditized product or service. You don't want a company that, is too reliant on a few suppliers. An example for that would be Foot Locker. Foot Locker drives 40% of their sales from Nike. If Nike decided we want to sell all of our shoes online, Foot Locker is probably out of business. So that's an example of where, you need to be thinking about the other stakeholders in their business and how much power they hold over the company you want to invest in. So you want to have a company that's attractive competitive positioning in that. And so explore back to waste management. I thought that was attractive because waste management is, I want to say, roughly 15% of the total market share of the American waste services business. They're the biggest. there's barriers to entry because there's long-term contracts. Like you'd have to wait for these contracts to roll off for with their customers. Some of those could take 8 years. From a substitute perspective, there's no substitute. Either you get rid of the trash or you don't. And most people don't want trash piling up in their neighborhoods or their homes. So these are questions I like to ask myself to figure out, okay, is this a good long-term investment? Because if you do this analysis and you do it thoroughly, you'll be able to find where the potential risks are, and you can evaluate, are those risks material enough to upset, your thesis on the name? Or if they are material, how much cheaper does this stock need to be for it to be attractive? So those are kind of questions I like to ask. And I'd say the last pillar I like to ask myself, this is more specific to me as an ESG investor, but I would also say it's specific, I think, to a lot of people, is this a sustainable business model? Is there something about this business model that you think 10 years from now will not work? An example I'll give, Walmart. Let me make this clear. Walmart is going nowhere. However, one question I ask myself is, how long can Walmart maintain its profit margins? I ask that because Walmart average sales associate gets paid about $10, $11 an hour. What if the federal minimum wage in America goes up to $15? That means for the majority of your labor force, you have to now pay them almost 50% higher than you have been. So not that Walmart is a bad business, but I don't believe it's sustainable for them to underpay their employees. Another example, Tesla. I don't want to upset anybody. Tesla is a very popular stock. I know, I'm not saying to sell it, but they are very reliant on cobalt for their batteries. I don't know how many of you are familiar with some of the things that are going on in Congo and also some of the things that are going on in Bolivia with the recent coup, but most of the cobalt is controlled by countries that are, like, in order for these companies to get the cobalt, essentially America has to take over kind of economic control of these countries. Do you think that's sustainable? Perhaps. One reason that Tesla's been able to kind of fulfill out of orders recently is because Bolivia had a coup last year when they went under American control, and the Americans allowed U.S. companies, to have access to those mines. But the coup didn't succeed because they were able to elect out the new official and bring back in the socialism. And so I say that to say, is there anything about this company where they are getting over? Are they getting over by exploiting a country's natural resources when they really shouldn't have access to that? Are they exploiting labor? Nike, for example, it's kind of a dirty, well-known secret that a lot of their shoes are made by child labor. Is that sustainable? So I'm not saying that you should sell Nike. I'm not saying you should sell Tesla, because Tesla creates, carbon-free cars. That is a net positive for the world. But at the same time, you have to ask yourself, at what cost? If they can't build a Tesla for under $80,000 without paying the workers in Bolivia and Congo living wages, is this sustainable? I don't know. So once again, you can make money on these opportunities, but when you're thinking long-term, you need to think about also the way the world views certain problems. 15 years ago, nobody thought ExxonMobil or Shell had a going concern issue. Like, oil is it's everywhere. But there's starting to be this push towards renewable resources. So obviously oil isn't going to go away now, but there's question on if we reach what's called peak oil demand, which means, has the demand for oil peaked as there are new and cheaper technologies available to potentially, use for energy. So that's when I say, ask yourself about sustainability. Even if it seems like, well, they're doing fine now, they have these great margins, their stock's been up. Those all could be true, but always ask yourself, what is the catch? What is the card if you pull, or the Jenga piece, if you pull out all of it topples out? Because if you can figure out where those risk points are and identify, when those risk points are potential to bust, you can save yourself a lot of money. And I think one thing that gets lost in stock selection, particularly in the long term, is that you are almost better off eliminating big losers than just trying to pick big winners. Because a lot of times for big winners to happen, some people just have that insight. They have the, ability to connect the dots and say, no, this is a great stock. I think this is a good investment. I think it's going to blow up. And they're right. But a lot of those stocks also have a lot of risk of potentially going the other way where they just, they may be down 40%. So it's always good to ask yourself some of these questions about risks and if you get comfortable with it. Now, obviously, if you're in the stock market, you are a risk taker. So you will never find a stock that has no risk, but you have to find the balance of risk you are comfortable with at the price you are paying. I hope all that was clear. I'm actually about to finish up. I think we should have about 20 minutes of questions or 25 minutes of questions at the end. We're about 11:30 right now. So kind of give a view of how I think about these. I'm going to give you a few examples of some stocks that I've looked at and what made them attractive. So one of the stocks that I really like right now is a stock called Otis. Otis went public this year. They are very large. I think they have a market cap of roughly 30 billion US dollars. But they were a spinoff of a large technology company called UTC. And so what Otis does, and I'm kind of going to go through what I like about it from the things I just outlined. They are an elevator manufacturer, servicer, and repair company. So if you have a new building, obviously, and it's, more than 2 floors, by law, you need an elevator to, accommodate people that aren't able to take the stairs. So basically it is mission critical for you to have an elevator in most, obviously, if you are in a residential building, you may have to walk up, but if you're in a commercial building and it's 2 stories, you have to have an elevator. So to me, that says, okay, any new building, somebody has to buy it, right? From a credit positioning perspective, Otis is the largest elevator operator and manufacturer. So there's no real, Amazon is going to get in the business of, building and installing elevators. So they will continue to be the largest player. We also don't know I don't know if any of you guys are familiar of the paper that is in elevators that says checked this date. That is legally required. So if you don't get that checked every year, and for some elevators that get more usage every quarter, every month, you will be in liability. So essentially, this is also recurring revenue. So even though, you may think of an elevator manufacturing company as, oh, they just build elevators, 80% of their profits come from servicing and repair of those elevators. And think about how annoyed you are when your elevator doesn't work. You need that to work, right? So I guess my point is that this is, no matter what happens, people are going to want elevators to work. Like that's just that, like they're going to pay for that. That is like keeping the lights on type of business. So that's why I like that. Also, like I said, 80% of the profits are from repairs. That is a service and asset-light business. It also has high profit margins, high free cash flow. So I like that. From a valuation perspective, because it just went public and is a spin out, it's not in any indexes. So even though it's a large company, it's not in the S&P 500, it's not in the Russell 1000, it's not in the MSCI Global, it's in no major indexes. So it's under-owned. So it's also pretty attractive from a valuation perspective. And from the secular tailwind that I was mentioning before, what I like about it is elevators are now incorporating IoT, Internet of Things, to better track when they need to be repaired, when they'll break down. So essentially, Otis has been able to install technology in, I think, 60% of their elevators, so they can live track, okay, for this model with this much usage and this many floors, this is on average how long it takes to break down. So rather than having to wait for an elevator to break down, they now have the technology and predictive analytics to say, okay, we're just going to send out a person this month because on average, this is when they break down. So the secular tailwind is the technology is improving. So if I'm thinking about a company X versus Otis, I'd rather go with a company where they can tell me when it's going to break down versus I have to call them when it breaks down. So these are some of the things I like to think about. An example of a company that I thought was interesting, kind of at surface value, but I ended up being not so interesting, is Netflix. Because Netflix has this secular trend, where people are staying at home, Netflix and chill, which has been a thing for 5 years. It's like Netflix is a part of our culture at this point, So it is mission critical. It is not going away. Even after the pandemic subsides, I will still be subscribed to Netflix. It is a service-oriented business. So that's a check mark for it, right? Recurring revenue. I pay that, well, maybe I do or don't pay, but people pay for the $10 to $15 subscription for Netflix every month. Somebody does. So that's attractive. Valuation, it's expensive, but I mentioned all these other things. The thing that got me about this company was that it had low cash flow margins and its attractive competitive positioning was bad. So when I ran some analysis, I thought, oh, Netflix has so many shows. But did you know that Netflix pays 5 times as much money for the content that HBO Max does? But HBO Max won 3 times as many awards at the Emmys. It was nominated for 5 times as many awards as Netflix. So it begs the question, okay, Netflix may have all these users, but it sounds like they're paying way too much for content that that isn't connecting with people. So my long-term concern is, listen, Netflix isn't going anywhere, but you can't continue to pay $20 billion on content and only make $15 billion in revenue. So, so when I went through this analysis, I realized, all of these other checkboxes are marked for Netflix. But when it comes to how they compete with, HBO, Amazon Prime, there's not really an advantage there, other than they just have the connectivity and the name recognition. So not that Netflix is a bad company, not that they don't have good content, but long term, I don't think you continue to overpay for content and deliver a profit. So that's just an example of an analysis where I said, okay, it checks all these boxes, but for whatever reason, these just aren't working. And I'll also note that if one checkbox isn't marked, there's probably a link to another checkbox. If it's a service-oriented business, it's probably asset light. If it's got secular tailwind, it's probably got a high valuation. And so all these things are interrelated, but I think if you ask these questions every time and you ask them thoroughly and go through that process, you can figure out, what is the level of risk that I'm getting and what do I think I could ultimately gain? Like what is the thesis here? And so if you think the risks there aren't big enough to really upset your thesis and your valuation is intact, go for it. So yeah, I'm going to conclude my presentation there. I hope people have questions. I'm really excited to answer your questions, and just keep in mind, this is my framework for investing. There are so many people who have been, very, very successful at this. This is how I like to think about going into investing, how I think about risk mitigation while still, capturing upside in this pandemic world. So hopefully that was helpful for you guys.
Thank you so much, Jerald. That was amazing. And yes, we do have some questions, and I'm going to pick them. Reminder, everyone, if you have questions, put it in the chat box, and I'm collating all the questions, and I would read them. But I can start with the ones we have currently. So the first one says, how would you suggest we look at companies' business strategies? What specific parts of their plan should we look at?
Sure. So if you talk about business strategies, I think the places you should look first is the 10K. Easy. Just because the 10K will say, what do they do? Who are their competitors? And they'll give you their perspective on risks. Once you go there, I would actually start to look at their product. So I'll give an example. I did some research on eBay, right? So I literally looked up, because everybody's familiar with eBay, competes with Amazon, competes with Etsy. It's a marketplace. So I looked up, okay, if I was a vendor, I looked up blogs that would let me know, okay, what would I rather have, Etsy, sell on Etsy, rather sell on Amazon, would I rather sell on eBay? And so when I looked and saw that Amazon had way more services than eBay, and I saw that Etsy was way cheaper than eBay, I thought, well, what am I missing here? If you're not cheaper and you're not offering more services, that's not sustainable long-term. Eventually customers are going to wisen up and either pay more for the services of Amazon and the customer base of Amazon, or they're going to go to Etsy and, save, 50% on their costs. So I think those are the places I'd look at. So the annual report, the 10K, as well as, if there's any blogs that talk about, the actual services or products that company provides. Because you want to know, is this a good product? Does it connect with its consumers? Does the services, are they differentiated? Because if the services aren't differentiated, the product isn't good, it's going to catch up to the company eventually.
Awesome. Thank you for that. So the next question is, what are your thoughts on cryptocurrency as a viable long-term investment?
So I don't think cryptocurrency as an investment. I think of it as a currency. So I want to make it clear. I think cryptocurrency has its place, but I think if you're looking at this as a way to grow your capital pool, I think that's incorrect. But using cryptocurrency as a hedge, I think is great. Because if there is any macroeconomic volatility, whether it's the dollar or, if it's the Naira, wherever you're at, like cryptocurrency will give you some protection because it's not linked to any federal bank. They can't print more money. They can't raise interest rates. Like it is totally independent of that. So my view of cryptocurrency is use this as a hedge. I think particularly, if most of your portfolio is, in Naira or another currency that may be a bit volatile, I think it's great to have cryptocurrency, but don't expect it to grow. Expect it to be a hedge to like your broader currency exposure. That's how I think about cryptocurrency.
Awesome. Okay, so the next question is a bit long, so just pay attention. Very nice talk. In evaluating a stock, how much importance do you place on the underlying tech and its ability to adapt? Your example on Tesla's use of cobalt is interesting. Cobalt is only 3% of Tesla batteries, and in fact, Tesla is moving away from it to lithium iron phosphate. In the long run, certain issues that seem non-sustainable today are really non-issues due to how things can advance with technology. So do you think perhaps more emphasis should be placed on technology evaluation and I guess innovation?
Yeah, no, I think that's a great question. So I think technology is very important. And I think when you look at the competitive positioning, that is a key differentiating factor. So when I mentioned the Otis elevators, I talked about how their elevators have the predictive technology to tell you when they're going to break. So I think that technology is important. My just point on Tesla is, what are you sourcing? So even if you have the technology, if the way you are sourcing, if it's labor, that's why I also mentioned Nike and Walmart, if you're sourcing something that may not be available for whatever reason, that's the concern I'm talking about. So if you've done the research and found that their reliance on cobalt is diminishing, then that's probably a catalyst to buy the stock. But what I'm saying is, so maybe Tesla's a bad example because to your point, they're moving away from that. But for a Walmart, they can't continue to pay people $10 and attract talent. So eventually they're going to need to pay people that $15, or the government will mandate them to pay people $15. They're going to have to pay people $15. So how they're currently operating isn't sustainable. So like I said, maybe Tesla was a bad example, but I just wanted to make that point that, if there's something in their business model that seems that maybe they're taking advantage of something, at the moment, it's probably not a good investment for the long term. But that's a great question. And, that's not something else where I don't cover Tesla, but I am aware of some of their sustainability issues given me my position as an ESG investor.
Awesome. And just to piggyback off of that, it'd be good for you to come back and kind of talk to us about ESG and what hat you guys wear when you think about investing, and just for people that are kind of concerned about that, I think it'd be really good. And I know I just volunteered that to you, but we can talk about scheduling and things offline. But you come back to kind of share that with our team. But we do have a couple more questions, and I can just jump right in. So if Amazon competes with all the companies to an extent, as you mentioned, should we just invest in Amazon and call it a day? But also note that Amazon is getting overpriced. What would you say about that?
Yeah, so listen, I think Amazon, I think you're right on the money. So I think Amazon has a place in a portfolio. Like, I think it is just too big. Like it is too big in terms of at least I'll say from my perspective, since we're trying to beat a benchmark, it is dangerous to not have Amazon in your portfolio, because if Amazon continues to do well, it's, almost 10% of the S&P or whatever it is, you're going to trail performance. What I would say is, I think you should continue to find companies that maybe Amazon aren't attractive to Amazon to enter for whatever reason, or Amazon literally can't. But no, you should always have a diversified portfolio. But I do definitely think Amazon, assuming, there's no ethical concerns based on how you feel personally, I think Amazon definitely has a place in the portfolio. But always have diversification. Even if it's 10 stocks, it's better to have 10 stocks than just Amazon. Amazon, that one stock portfolio may beat in certain times, but out of the long term, like 5-10 years, a diversified portfolio of Amazon plus 9 other stocks will probably outperform.
Awesome. We have 2 more questions. If you have questions, put it in the chat box. But the next question says, how do you eliminate between big losers, like you mentioned, versus picking big winners?
Yeah, so I mean, if I knew that question, I would be much wealthier. But I try my best to figure that out. But I guess what I would say, from a big loser perspective, what I think of, there's what's called value traps. So that's what I really try to avoid when I think of big losers. So there are companies that look so attractive from a valuation perspective, but they have underlying issues in their business that just don't seem to go away. I think the best example of a value trap recently was Boeing. So Boeing has been cheap for so long, and obviously Boeing is not going anywhere because it's like the largest defense company in the world, and it's like the second largest, I think, aerospace behind Airbus. So it's not going anywhere. However, people keep waiting for them to get their SHIT together, but they never do. So what I would say is, if there's a company that seems to always be cheap, there isn't really a clear catalyst to them improving their economic performance, that to me is a no-no, because things are really cheap for a reason. There needs to be a clear catalyst that the rest of the market isn't seeing. Just because it's cheap and cheap for a long time and you think it won't go away, that doesn't make it a good investment. That just means it won't go away and it's cheap. Like, I know that's not a perfect answer, but I think there is, like, just because it's cheap and it won't go away, there's still a lot of ground to be made up in terms of, okay, are the revenues recurring? Do they have good profit margin? You know, what's the credit positioning? I feel like when you find a company that's cheap and a company that, you know, is not a going concern issue, that's start to ask these other questions. Like, to me, that's the opportunity to do some research, because then you can figure out, okay, is this cheap stock that's not going where? Is it a good investment? Because it's not always the case. You got to do some of that legwork in between to figure that out. I kind of went around in circles for that answer. I'm sorry.
No, you're good. You're totally fine. The next question. So we have two more questions now. Someone just put a question in the chat. Great talk, Jerald. How much emphasis would you place on valuations when deciding to invest? Yes, the underlying business looks great, but the stock is quite expensive. Do you still recommend investing in such a situation?
So I would say in certain times, yes. So there are a few companies that I invested in that were expensive, but I thought they had strong growth and very strong margins. And those were Adyen, which is a Dutch payment processor, and MSCI, which is a business services company that serves financial corporations. And the reason I was comfortable with their valuation, because when I looked at it on a relative basis, so when I looked at them compared to their peers and looked on a DCF based on my forecast, it makes sense. So even on a relative basis, you know, they might have been expensive. I said, there's a reason they're expensive, right? So when I looked at some of their operating measures, I saw, okay, it may be more expensive on a EV to EBITDA or a PE perspective, but I look at price to free cash flow, and free cash flow is what I really want at the end of the day. It's not so cheap. Or if it's more expensive than all its peers, but it's got stronger growth, it's got higher margins, to me, then that's why it's more expensive. And as long as it's within reason, which is totally arbitrary, I think it makes sense. But if there's ever something that looks expensive, do a DCF. And if the DCF with your forecast and discounted cash flow, sorry for those who don't know the acronym, if it still looks expensive after that, and you can't find a rationale for the reason it is trading at a premium to its peers, I think it's too expensive. So I would just say go through those two processes if you think a company has a great business model, but it's just a little pricey. Because sometimes, even if it is pricey, it could still go up. So you just need to ask those questions: margins, revenue assumptions, and are there any other kind of DCF or any other potential ways to value it that could give you a bit more clarity on what it should be worth.
Okay. All right. That's noted. The last question we have here. What are the key metrics and questions to ask yourself when investing for the long term? And I know we kind of graced on this, but it'd be good if you can just,
Yeah, so I would say, there are definitely a lot of industry specific metrics I like to look at. But the first things I like to look at are, so there is a metric called return on invested capital. There's like a formula to find that, but at the same time, a lot of times companies will just disclose. I'm sorry, pardon me, that's what the return on invested capital is. So I would say look at that number over time. If that number is stable or improving, that is a sign of a company with an improving competitive positioning. I would also say look at revenue. So look at revenue growth. Look at how much dividends they issue as a percent of revenue. How much in mergers and acquisitions they spend as a percent of revenue, how much they spend on capital expenditures as a percent of revenue, how much stock they buy back on a percent of revenue, and what their revenue CAGR is for 3 years, 5 years, and the last year. I think that is the best way to get a snapshot of a company. If you know what the ROIC trends are, what they spend their revenue on, like where their costs are, and what their revenue growth are, that will give you a good snapshot on what to expect.
Awesome. We have another question here. What is your opinion on investing in early stage Chinese tech companies on the long term?
I'm gonna say, look, I have never invested in Asia. I've never done research in Asia. I've never invested in Asia, so I really don't want to comment. I mean, I wish I could help you, but I really don't. I mean, I think China's obviously, the other kind of superpower in the world. They're growing. They manage the virus extremely well. So I mean, I don't think there's anything wrong with China from like, an economic perspective. I just want the expertise to tell you, anything more than that.
Awesome. Jerald, it was a fantastic run with you. And to everyone who joined us, thank you so much for making time. This session is recorded and will be going on YouTube in a few minutes after this session is over. Again, just to reiterate, we do have 2 more sessions coming up, and that would be next Saturday and Sunday at the very same time. We will kind of dispense the information around how to join and things like that. Don't forget to follow us on social media at Troll Finance. You can also follow us on YouTube to make sure that you get the information from yesterday's session. If you missed it, it was phenomenal. And of course, today's session was amazing. Our YouTube page is Troll Finance. If you have any questions around Troll, how to use it, or anything like that, feel free to shoot us an email at hello@app.co. You can also join our Telegram group. I think I put that link in the chat box yesterday. Happy to put it again. But yeah, thank you guys so much for making time. We will be doing this again, and I'm sure Jerald will be happy to be back to talk about ESG and how they evaluate companies and the things that they look for and the levers that they kind of put together. But this was an incredible session. Thank you so much, Jerald.
Thank you so much for having me. I also just want to let anybody know if you have any follow-up questions or just want to connect, you could search me on LinkedIn and I'm happy to answer your questions or just, talk about anything. So I'm available.
I think we lost you there. I think your volume cut off.
Okay, can you hear me now?
Can you hear me? Yes.
Okay. Yeah, I just wanted to let y'all know if anybody wants to connect on LinkedIn, my LinkedIn name is just Jerald Gooden. My email address is gerald.gooden@alliancebernstein.com. So if you have any questions or anything like that, I'm available. It was wonderful speaking with y'all, and I look forward to having my ESG session.
Fantastic. Thank you, Jerald. Bye, everyone.
Thank you, Jerald. Bye.
Bye.